ठीक है, तो स्टार्ट करें। फ्रेंड्स very good evening to all of you. This is Dr. Aditya Srinivas, Chief Operating Officer and Chief Economist from the BSc Broker Forum. Today, this particular session is based on current developments in the economy, friends. See, as far as current developments in the economy is concerned, when we are talking of current developments very good evening to all of you. In this particular situation, let us first understand Chief Operating Officer and Economic aspect, from the and then we will go to the stock market perspective. Today, this particular session is based on current developments in the current scenario. If you see, the IMF, International Monetary Fund, has projected the world GDP will be around 1% or even less than that, in view of the current ongoing pandemic situation, that is coronavirus, which has forced more than 200 countries to go for lockdown and which has killed demand and consumption in the economy. So this is one aspect we have to keep it in mind. Apart from this, if you see, their projection about Indian economy is that it would grow at around 1.9%, which definitely shows their confidence about the growth prospect of our economy. Our current GDP, however, is around 3.1% from January to March 2020 quarter. It is 3.1%, and this basically GDP is definitely somewhat lower. It is at a 44 quarters low as compared to our average GDP of 7.5%, which has been our average for the last 20 years. So this is something, friends, because of coronavirus, that the demand and consumption was forced to stop because nation entered into a nationwide lockdown for the last more than 90 days. However, since June 1st, there has been unlock and there have been certain signs of what I can say green shoots in the economy. Green shoots in the economy are something like, friends, that as far as the green shoots in the economy are concerned, the April to GST collection, friends, the April to GST, April to June GST was 1.85 lakh crore rupees. 1.85 lakh crore rupees. That was April to June GST. That shows primarily certain amount of green shoots in the economy, friends. That certain amounts of green shoots in the economy have already started coming, and that primarily tries to ensure the kind of growth rate. Hello. Yes, friends. So we were primarily trying to discuss the economic aspect. If we see from April to June quarter, if we see from April to June quarter, friends, the GST collection has been around 1.85 lakh crore rupees. That shows the economic prosperity that slightly, slowly and gradually what the economy is trying to gain at. Not only this, friends, if you are basically seeing the June sales data, if you try to see the June sales data of the automobile sector, in that also you will find that the tractor sales were at 90% of the pre-COVID level. Tractor sales were at 90% of the pre-COVID level. Then four-wheeler passenger car were at 60% of the pre-COVID level, and basically two-wheelers were at 70% of the pre-COVID level. This is something, friends, we have to understand that as far as primarily the economy is concerned, it has already started showing signs of green shoot. This is basically what I can see, friends. Always remember that as far as our economy is concerned, friends, apart from this, slowly and gradually economy is coming back to normalcy. Not only that, if you see what I can say, the corporate results also, several companies have posted their corporate results which are relatively in a better position, and their net profits are slowly and gradually rising. So this is again we have to keep it in mind that net profits of the corporates were not that bad as they were anticipated. Apart from this, friends, if you see the global economy right now, everywhere in the world, all central banks have reduced their interest rates drastically. The whole logic of central banks was to reduce the interest rates so that they are able to create demand and consumption in economy. The interest rates have also been at historical low levels. If we talk of US economy, friends, if we talk of US economy, the interest rate is between 0 to 0.25%. In Europe, it is 0.5%, UK is 0.5, and in Japan, there are negative interest rates. Even in the current scenario, friends, if you see, the RBI took an important step and they reduced the repo rate to 4%, which is at a 10 years low, friends. The repo rate has been reduced to a 10-year low of 4%. So this primarily shows that the whole intention of RBI is to ensure that the cost of capital is at a low level and we are able to generate sufficient amount of demand and consumption in the economy. So this is what the whole logic of the government and of the RBI is. Nevertheless, friends, in the current scenario, even though interest rates have gone down, the risk still persists in the economy as demand is not picking up as it was supposed to pick up, for the simple reason that lot of people have lost jobs in the corporate sector. Lot of people have lost jobs in the corporate sector and they are unable to create jobs in the economy. So because of this fear, even those whose jobs are stable are not going ahead and doing any kind of capital expenditure or basically trying to take a loan. So because of that, friends, the current economic scenario is slightly grim. If we see the unemployment situation in India, then in the month of March, March 1st, that is before the lockdown, the unemployment scenario was 6.1%. After the lockdown, the unemployment has increased 27%. The unemployment has gone up to 27%. So that basically creates an issue in the economy. The unemployment figure is right now at 27%. So that is something a challenging task for the economy, friends, for the simple reason that if employment is not generated in the economy, then how you will be able to create jobs, and if that doesn't happen, how will demand and consumption get created in the economy? So this is something, friends, you have to keep it in mind. This is something very vital. Apart from this, if you see the stock market perspective, then in the last 6 months, friends, our stock markets had a roller coaster ride. In the month of January 2020, that is in the month of January, the foreign institutional investors had invested 12,000 crore rupees in the Indian stock market, and markets relatively made an all-time high of 42,273. 42,273 was our all-time high on January 20th. In the month of February again, we made in the month of February, we again they invested around 10,000 crore rupees into our markets. But as the fear of coronavirus spreaded across the world, in the month of March, friends, in the month of March 2020, they were net sellers to the tune of 61,000 crore rupees. they were net sellers to the tune of 61,000 crore. As a result, the markets crashed from 42,000 levels to 25,600 levels. The markets drastically came down. But you will be surprised to know, friends, that since India implemented lockdown much effectively and very quickly as compared to other nations, the foreign investors took this step of the government with a positive sense, and in the month of April, the sales reduced to only 1800 crore rupees of foreign investors selling. Then in the month of May and June, friends, foreign institutional investors became net buyers, and in the month of May, the FIIs purchased shares worth 14,500 crore rupees, and in the month of June, they purchased shares for 20,000 crore rupees. So that means for the month of May and June, FIIs totally purchased around 35,000 crore rupees of shares, and this basically created huge amount of returns for the retail investors also. In the last 3 months, retail investors, the overall market gave a return of, overall markets have given a return of 30%. BSE Sensex appreciated by 30%. So that basically clearly shows a long-term growth of the economy and that of the market. This is something, friends, very vital and important as far as the market is concerned, as far as the stock market is concerned, friends. Not only that, in this current scenario, if you see the last 6 months data of institutional flows, then FIIs have been net sellers. FIIs have been net sellers to the tune of 25,000 crore rupees. They have been net sellers. Whereas if you see mutual funds, they have been net buyers to the tune of 39,000 crore rupees. They have been net buyers. So this is something, friends, very important that we need to understand, that today Indian mutual funds have become the backbone of our economy. Indian mutual funds have become the backbone. If you see in the current scenario also, just imagine that had mutual funds not invested 39,000 crore rupees into the markets, had mutual funds not invested 39,000 crore, where would Indian stock markets be in the current scenario? The way it would have crashed, that would have something very huge crash into our markets. So they have become a backbone. Currently in the mutual fund industry, if you see, friends, around 2 crore mutual fund investors are there, around 2 crore, and basically they are investing maximum money through the SIP route. SIP is systematic investment plan, friends. SIP stands for systematic investment plan. So basically when we talk of SIP, they are investing around 5,000 crore rupees into stock market. So one thing, friends, is very clear, that SIP has become, what I can say, the backbone for a retail investor. Retail investors are investing in our economy in a big way, friends. So they are primarily trying to invest through the SIP route, where minimum amount is only 500 rupees a month, and you will be surprised to know that every month around 5,000 crore rupees, 5,000 crore is coming into Indian stock market through the mutual fund route. 5,000 crore rupees is coming into Indian stock market through the mutual fund route, and that shows the strength of Indian mutual funds. That is something, friends, very critical and important aspect that we need to keep it in mind. Always remember, friends, that as far as mutual funds is concerned, there are 43 mutual funds in India and more than 1000 schemes. 43 mutual funds and more than 1000 schemes are there. So basically, if you see the total amount managed by mutual funds, the total amount managed by Indian mutual funds are basically, the total amount managed by Indian mutual funds is around to 27 lakh crore rupees of fund is managed by Indian mutual funds. And this is something, friends, remarkable, because in the year 2004, when I just started my career, the total amount managed by Indian mutual funds was only 1.5 lakh crore. So basically, you can understand the kind of growth Indian mutual fund industry has been able to create in the economy. So that is the impact of mutual fund, friends. That is something very positive sign for our economy. In the current scenario, friends, please understand that when you want to invest in the markets, you have to invest in large cap stocks and preferably Sensex based companies. The logic is that if you have invested in Sensex based companies, if you have invested in the Sensex Yes. If you have invested in a Sensex based stocks, friends, then obviously your long term return would be much better as compared to the mid cap and small cap companies. Your long term return would be much higher, friends, for the simple reason that ultimately Sensex stocks always bounces back. So when Sensex stocks primarily bounces back, obviously you will be able to generate good amount of return in the long term. You will be able to generate good amount of return in the long term. Always remember, friends, that as far as the BSE Sensex stocks are concerned, one can basically buy in BSE Sensex, one can always try to buy stocks like Reliance Industries, HDFC, then HDFC Bank, the basically Infosys, TCS. These are those stocks which you can buy over a period of time, friends. Never buy these stocks in one shot. If you buy these stocks in one shot, obviously there are chances that after you have bought, if the markets go down, then definitely your portfolio will get stuck. So it is very important that ultimately you buy stocks over a period of time. This is something, friends, you need to keep it in mind. Always remember that when you are buying the companies, buy companies with large cap bias, friends, so that these companies are able to withstand any kind of downturn in the economy, any kind of pressure in the economy, since their balance sheets are big and they are fundamentally very strong. This is something we have to keep it in mind as far as the large cap stocks in the Sensex are concerned. See, if you see, friends, two things you have to consider whenever you are buying a stock. One particular thing is net profit of the company. Always remember, one has to buy only those stocks whose net profit is rising, for the simple reason, friends, that if the net profit is rising, then these stocks will be purchased by mutual funds and FIIs, and when mutual funds and FIIs purchase the stock, obviously the return of the stock will go up. See, a stock price does not rise by you and my buying 100 shares, 200 shares, but these particular shares will rise only and only if they are picked up by the institutions, and institutional investors will buy the stock only when institutional investors will buy the shares, friends, only when institutional investors will always try to buy the share only when they feel that the net profit of the company is rising. So this is something, friends, very critical and important factor whenever you select a stock. The second key feature of the markets are of the particular company is debt equity ratio, friends. Always remember, a company with a lower amount of debt equity ratio will always perform better as the company will not have any financial obligation. See, we have plethora of examples where companies having higher amount of debt were ultimately had to shut down their operations and companies could not give any returns to the shareholders. For example, if you take Kingfisher. Kingfisher was once second largest airlines of India, and then they took a loan of 7,000 crore rupees, which ultimately could not be repaid back by the company. And today you are aware what is the scenario. If you see Jet Airways, the company with the largest domestic flights in India, that particular company, again, friends, if you see, had taken a loan of 8,400 crore rupees, and again that company also, friends, could not survive, and today we are witnessing that 22,000 people ultimately lost jobs in the economy. So that is the second important aspect. The third aspect, if you see about the economy, or the third example, if you see, that is Reliance Communication. That stock was once above 500 rupees, today available for less than 1 rupee. Again, 46,000 crore rupees of loan taken by the company, and company could not repay that capital or that loan properly, and the result is shareholders wealth was completely eroded. Friends, always remember that whenever you are buying a particular stock, whenever you are buying a stock, it is very important, friends, that you buy a company which is zero debt company or near to zero debt company. This is something very critical and important. A company which does not have debt is obviously bound to survive for longer duration, because it will not have any financial obligation. See, companies like Infosys, Wipro, TCS, then Maruti, HDFC Life, Reliance Industries, all these are zero debt companies. So basically, when you accumulate these kind of stocks in your portfolio, your probability to make higher capital appreciation is always there. and you will be able to make good amount of return in the long term. This is something, friends, you have to keep it in mind as far as the investment aspect of the stocks is concerned. Apart from this, you can also see parameters like dividend payout ratio. See, any company which is paying good amount of dividend, friends, always remember, will be able to generate good amount of capital. This is something you have to keep it in mind, because dividend is paid only out of net profit. So a company which is regularly paying dividend is definitely fundamentally a sound company, and you can consider that company for your inclusion in the portfolio. So this is something, third parameter which you can see. The fourth, you can always look at what is called as liquidity ratio, where basically current asset upon current liability. So liquidity ratio is again something important, whereby, friends, if you are investing in any particular asset, if liquidity ratio will refer to current asset upon current liability. So this is something again you have to, friends, keep it in mind. So here short term payment obligation, if the company is able to have, then in that particular case company will not have any financial pressure and will be able to perform well. This is how, friends, you have to keep it in mind as far as the investment aspect is concerned, friends. Please understand that in the long term, you will be able to generate money if your company's selection is fundamentally sound and they are large cap and basically debt free companies. Please understand, friends, that if the company is large cap, the stock price will always bounce back. So that is that your capital will not get stuck for longer duration. So that is one thing. And second important aspect is that if the company has zero debt equity ratio, then it will not have any financial obligation, and ultimately the company will be able to sustain any kind of downturn in the economy. So these are the points, friends, which we need to keep it in mind as far as the investment aspect is concerned, that debt equity ratio should be 0 or near to 0, and at the same time you should buy stocks which are large cap in nature, and at the same time these stocks are fundamentally sound, of large size, so that you are ultimately able to generate good quality returns in the long term. So this is how, friends, you will have to consider whenever you do buying in the stock market. One another current scenario we would like to discuss here is the movement of gold. In fact, today gold has touched 50,000 rupees. Please understand, friends, that gold as an asset class has inverse relationship with three things: equity markets, world economy, and US economy. That means whenever there is a problem at the global level, gold prices will always go up, and whenever things at the global level are better, gold prices will come down. So gold always behaves in an inverse relationship. The logic for this is that gold is most liquid asset after cash. Gold is the most liquid asset after cash. So this is something you have to keep it in mind. So institutional investors, what they will do, whenever they basically feel, whenever they will feel that equity, mutual fund, bonds, or other asset classes, real estate, are not yielding any return, then in that particular case they will start investing in gold, friends. They will start investing in gold, and as a result gold prices go up. Always remember, gold will give you sporadic returns. When I say sporadic return, means whenever there is some problem at the global level, gold prices will go up. If globally things are okay, then gold prices will come down. So the moment you will see that if there is a corona vaccine available, and if the economy returns back to 100% capacity, if the economy returns back to 100% capacity, then in that particular case you will find equity markets again performing well, and in that particular case you will see, friends, equity markets doing well, but at the same time you will find that higher returns will come from stock markets, because gold will ultimately go down. So this is something, friends, you have to keep it in mind as far as the gold as an asset class is considered, friends. Please understand that in the long term, if you will see, in the long term gold will always outperform other economies. But as far as equity markets is concerned, friends, if you see from 1979 till date, if you see, then gold, the return of BSE Sensex is 16.5%, whereas that of the gold is only 9%. So in the long term, equities always perform much better as compared to gold as an asset class. This is something you will have to, friends, keep it in mind. So in today's session, I think we have covered how equity markets perform, how basically gold performs, and ultimately what is the relation between equity and gold also. Plus we have understood the concepts of mutual funds. So please understand, friends, that in an overall segment, whenever you invest in large cap stocks, invest in mutual fund SIPs, and you can have 10 to 15% exposure in gold also. You can always have 10 to 15% exposure in gold, so that whenever equity markets are not performing, gold will definitely perform. This is something you will have to, friends, keep it in mind. So with this, I feel, friends, that our this particular what I can say live series, it comes to an end, and in the next session we will again try to discuss with some current global topic. Thank you very much for giving us a patient listening. Thanks a lot, friends.